The housing market has been insane over the last few years, and as we head into 2024, you may be asking, are we looking at more of the same?
The housing bubble on the horizon for 2024? That is the question.
2024 is going to bring, and I'm quoting him now, the biggest crash of our lifetime.
Mortgage rates have dropped dramatically in the last few weeks after rising for much of the year, but will that be enough to kickstart the housing market in 2024?
All of the experts are trying to predict what's going to happen with home prices, mortgage interest rates, and inventory. But there are a few key factors to look out for to watch for signs of a housing crash. I want to dig into each of these factors a little deeper and then let you decide whether 2024 is the year that home prices finally do crash or whether they go in the opposite direction and actually appreciate into another 2021 crazy home market. So the three main factors for predicting a market crash are going to be economic factors, followed by housing supply, and then rounding it off with mortgage rates and lending practices. Now, economic factors have a huge bearing on what happens with the housing market. In an inflationary market, the cost of living increases, and when the cost of living increases, it puts a strain on household finances. And one of the reasons why we've seen so much talk about a housing crash is the strain on housing affordability. And over the last few years, we've seen the inflation rate go up as high as 9.1%. However, with the Fed raising rates, that put downward pressure on inflation, and inflation has been gradually easing since then. In this recent article by Reuters in January, they go on to say the survey's reading of one-year inflation expectations fell to 2.9% this month, the lowest level since December 2020. That was down from 3% in December and put these inflation expectations within the 2.3 to 3% range observed in the last years prior to the pandemic. So that's the goal of the Fed, is to get to that 3% range. But what we don't know is what is out of the Fed's control. Things like unemployment. If there's a significant increase in unemployment, that could send the economy in a tailspin. If there's a shift in consumer confidence, that will affect what the Fed does. So the crash warnings when it comes to economic factors are going to be a significant increase in unemployment, a decrease in consumer confidence, and in significant changes in the inflation. Now, the second key factor that will trigger a market crash is going to be housing oversupply. When you have an oversupply of homes and not enough buyers to purchase those homes, that's when you start seeing housing prices decrease, price changes increase, and longer market times. One factor that could trigger that is speculative investing. There are companies that are buying large number of homes and they only care about one thing, and that is making money. And if those homes are not making money, if those assets aren't creating wealth for that company, they're going to dump it. And in the process, that could tear apart a neighborhood. If you have companies that own 50% of a neighborhood and all of a sudden those companies decide to list the properties for bottom of the barrel prices, all the rest of the property values are going to drop in that neighborhood. So a crash indicator would be if all of a sudden you start seeing a lot of homes in your neighborhood that are owned by corporations start going on the market, but not only go on the market, but list for less than what the market value is in that neighborhood. Now, the other element that could contribute to housing oversupply is new construction. Now, we saw this in the crash of 2006. Builders overbuilt before the crash. And when the crash hit and prices started to slide, those builders were stuck holding notes on properties that they couldn't get rid of. And they started having deep discounts, offering huge incentives to buyers to get out from underneath these properties. And because they got burned so badly, they pulled back and they stopped building spec homes, where a builder would go in and build an entire neighborhood before they actually have the buyer's deposits to purchase those homes. And instead, they've gone to an on-demand approach where a buyer will look at a lot plan, pick out the lot, and then the builder will build the house to the specs of the buyer. Now, because the inventory has been so low, buyers have been willing to wait 6 months, 9 months for the new construction of their home. So what does a crash scenario look like with new construction? Well, you would need the builders to get back to building by spec. You would also need low cost of materials, low cost on land, low cost with acquisitions, which means low interest rates, a good supply of laborers, and minimal obstacles to build. And all of these things are just not lining up right now. The cost of materials is still through the roof. Prices have come down, but they're still way above where they were since 2006. The cost of land has not come down. Interest rates are starting to come down, which helps, but they're not at the 2 and 3% that they were a few years ago. Labor shortage is still a real thing. It is increasingly hard to get good, skilled, reliable laborers to help fill all of the needs of building a home. And when it comes to obstacles to build, it is probably the hardest it's ever been to build a home. I would say firsthand in my hometown, Plymouth, Massachusetts, that it is extremely difficult to build a home. The requirements for a builder are so high because the town is trying to protect open space and they want to protect the quaintness of the town. But it's incredibly hard, and it makes it super hard for a home builder to build affordable housing. If they're going to jump through all the hoops that they have to go to get a home built, they're going to make it a high price tag luxury home. They're not going to make it an entry-level home, which creates a huge obstacle for home affordability. So when it comes to housing oversupply, the warnings of a crash that you're going to want to watch are speculative investors flooding the market with homes, builders overbuilding with new construction, and more inventory on the market than there are buyers. Now, real estate is local, and if you're thinking about making a move, you want information about your community, your town. Now, I've been in the business for over 25 years. I have built relationships with the top agents in the country, coast to coast, and I can connect you with one of those agents that will take great care of you. Just click the link down below. There will be no sales call, but I will get back to you within 24 hours, and I'll connect you with one of the best agents in the country that will give you the most updated information and will take great care of you. Now, the third element of a housing crash is definitely going to be the mortgage standards and interest rates. Now, the 50-year average for the interest rates is about 7.5%. So we've seen low rates since about 2010, but during the pandemic, we saw historically low rates. Now, typically when you have lower interest rates, that means more home affordability. But when you have home prices that went through the roof, we actually saw a negative slide in home affordability. Now, there was a ton of cash that was injected into the economy during the COVID years, and that helped offset some of that home affordability. But as soon as that cash dried up, the inflation started to increase to kind of offset. The Fed has to make up for that money that they gave away. So who ends up paying for it? The consumer ends up paying for it. So we see higher inflation prices, bread prices, egg prices, gas prices, everything went up. And to keep that inflation down, the Fed has had to raise the rate. And as they're raising the rate, that home affordability gets further and further and further away. And that is why we've started to see home prices. They're still increasing, but not increasing at the rate that they were at. And buyers are starting to pull back. Now, where rates are headed in 2024 will largely depend on what the Fed does. But I pulled this article up by the National Association of Realtors, quoted Lawrence Yun, who is the chief economist over at NAR. And he goes on to say the NAR is predicting the average will be 6.3% by the fourth quarter, down from 7.8% in 2023's final 3 months. He goes on to say that this will potentially entice people to put their homes on the market because they're willing to give up those 2 to 3% interest rates to get on to their next home. 6.3 is not far off from where we are now, which means that we might see just kind of a casual bumping along. Not really an indicator of a crash. Now, if we start seeing some of those economic factors come into play where the interest rates actually start to go back up, they start creeping back up, which causes buyers to pull back, which decreases the number of buyers actively looking in the market. Now that inventory starts to pile up, and those new construction homes, maybe people pull out. And one of the key things that I always look for is homes that have price changes or cancellations on contracts, because that could cause that inventory to start to creep up, build up, and that could be a huge red flag of a pending housing crash. Now, the other element that we have to watch is lending practices. We saw this in 2006. That was the key reason why the market crashed in 2006, was because lending practices pretty much went out the window. The saying went when I was selling real estate back then, it was if you could fog a mirror, you could get a mortgage. And it almost was true. No income verification loans. You could walk into a mortgage office and say, I want this amount of money. I make this amount of money. And they would just write the loan. They wouldn't ask for pay stubs. They wouldn't ask for verification of where the money's coming from, proof that you actually are making the money that you're making. They would just give you the money. It was way too easy. Coupled that with appraisal practices that were, to be honest, shady at best, where you would actually have lenders working with appraisers to make sure the numbers work. And it was a recipe for disaster. And if that comes back, or some sort of element with the lending practices, it starts to get a little too easy to get money. If people are able to bend the rules a little bit too much, then you start seeing programs of people that are are waiving the rules with FICO scores and things of this nature, and lower down payments or no down payments. Not all those loans are bad, but that is something that absolutely could be a warning sign for a potential crash. So the warning signs for a crash when it comes to mortgage standards and interest rates: becoming too easy to get a mortgage, skyrocketing interest rates, and a continued decline in home affordability. The next 12 months will be interesting, and right now it looks like it's going to be largely uneventful, which I absolutely welcome, but who knows what can happen. We have an election year, we have inflation that's not yet under control, climate issues are popping up all over the place. All of these things affect the housing market, so it's going to be interesting to see where we're at 6 months from now and how close that is to where we are today. I'm Jen Sylvester, and I'm here to make you a savvy home seller.